after a week characterized by more teasing from the Fed, more bond yield increases, more opportunities to get good deals on huge plays, and as the infamous can't stop, won't stop GameStop approaches its earnings date this Tuesday, and as people, for better or worse, threw other stimulus checks into Bitcoin and stocks. And with all of this in the forefront, we must talk about the top 3 stocks for this week. But first, let's go ahead and talk about some of our recaps from last week. First recap, Jiva. So Jiva had a pretty nice bounce on Friday, up like 18%. We've been talking about this one a decent amount in the last couple of weeks, and it's really performed well in terms of a bounce. But don't be fooled. The focus of the market right now isn't really on green tech. Yes, these have bounces, but right now the focus of the market is COVID relief, interest rate panics, and some recovery plays. But as and or if we leave the pandemic, you're going to start seeing some more focus on these green tech plays. And you want to make sure that Jiva is one of the big ones that you're watching. But while Jiva likes to go up massively, it also likes to go down massively. If you look at its uptrend during the end of 2020, beginning of 2021, very clear that Jiva likes to have these 30, 40, 50% drops. A lot of people like to employ what I call toxic buying when it comes to plays like Jiva. They're not convinced that it's a good play until it's run up a decent amount, so they buy here at the top, and then all of a sudden everybody panics. It goes down 40, 50%. They figure, oops, okay, everybody's selling it, that means it's a bad play. They sell out at a loss instead of adding more, and then all of a sudden it comes rallying back. The key with a play like this is not so much following the market movements, but rather valuing it correctly and then buying it at a dip. If you're the type of person that doesn't like to hold through dips, that's fine. Buy it at a dip and then lock in profits as it rallies up again. My price target on this one is $18-20. In terms of some of the learning takeaways from our briefing plays, Upstart, ticker symbol UPST, was one that we briefed on Thursday morning in the pre-market. This is a next generation lending company. They had jumped just last week on analyst upgrades and strong Q1 guidance and a new acquisition. Upstart is a company that uses AI integrated technology to lend to customers using non-traditional qualifications. Basically, it takes advantage of the fact that while 80% of Americans have never defaulted on a credit product, only 48% of Americans have access to prime credit. If you look at those two numbers, there's a large disparity between people who actually would be good to lend to and people who actually can get funds lended to them. There's a lot of Americans that should have access to quality loans that don't have access to it. And in this way, Upstart can take advantage of that by slithering their way in and using their AI to grant people loans using criteria and technologies and databases that traditional lenders don't. And with most loans being fully automated, that means that an increasingly large percentage of them can be approved instantly, which means more convenience for all parties involved. And we like convenience. But here's the thing, the crux of why it jumped last week and why we briefed on it was because they're now venturing into the auto financing sector, which is one of the biggest loan sectors of the US. Most Americans need a car, and because there's so many people that can't get good car loans, there's a huge demand in that sector. So Upstart acquired Prodigy, which brings Upstart into the auto financing niche. And clearly this is a huge market and one that is incredibly relevant for folks who are unlikely to default on credit products, but also don't have access to traditional forms of prime credit. Anyways, we briefed on this one Thursday in the pre-market, and it ran up a decent chunk more from the low 80s to the high 120s. But the overall learning takeaway here is that good and successful business models merging into bigger markets, that's a huge catalyst because that means more and more moolah. And that's exactly what we saw with this play. Okay, the other one I want to update you on is Fedex, the X of the Fed. Wait, that doesn't make any sense. Looks like he is still married, ladies. Sorry to let you down. I hear he has very low interest in other women, but certainly is keeping all tools on the table in case of a further crisis. Although I have to admit, Mrs. Powell might not trust him for long with those rising bond yields. He may say low interest, but hey, do you see those yields? She may be considering quantitatively easing out of this relationship real soon. Oof, that was terrible, folks. I don't know why you watch this channel. But anyways, no disrespect, back to Fedex. This has been one of our slower plays from the price targets, but we talked about this as cheapening post-earnings, but likely to bottom soon, and we've been saying that since late January. We did have some bottoming out, and it beat on earnings last week, which caused an overall nice bounce as well. Pretty nice run from the bottom, pretty solid play so far. Still have upside to 320 in my opinion. Okay, last update, Clove. I downgraded Clove this morning to a lower exposure grade. C+. If you don't remember, basically they were hit with a short sale report a month or so ago. I found the allegations to be overblown, and I thought it would dog down Clover for probably a couple months. and then afterwards we'd see a bounce. However, because of the consistently bad PR and the whole environment that we're in now with the rising interest rates and the scares with that, I don't think it makes sense to have a lot of exposure to some of these more risky investigation short seller type plays. So for me, my exposure rate is going to go down a little bit. I don't think the value of Clover is any less. I'm not going to be downgrading the price target. It's at $20 and it's going to stay there unless we get new information that's material to my price target. I think that we're going to get some stagnation. This is going to be a slow recovery play, and I feel safer downgrading this and lowering the risk because of the overall market environment and how this has been playing out. But even at CC Plus, I mean, if you're willing to ride out the storm, this is probably going to be a pretty decent play. Okay, folks, anyways, let's go ahead and get into this week's plays, and the only thing I ask of you in return is that you hit that ravishing like button, and also don't forget to subscribe. Also, quick plug, if you'd like to learn how to trade, would like access to our private chat, daily morning briefings, as well as our price targets, well, I'll make sure to give ZipTrader you a look. I'll put the link below. But take some time to think about it. We're not going anywhere, so we'll be here whenever you're ready. Just, get your tea, drink some tea, and think about it. I got this new passion fruit tea. Doesn't have any caffeine in it, which is unfortunate, but it tastes great. Okay, first top stock, Blink. So Blink Charging is one of the leaders in charging stations. They're also trading a chunk down from all-time highs, almost halfway down actually, and they're also reporting earnings on Thursday. Who cares? Well, I care. As you know, the electric vehicle market is expected to grow from 1 million vehicles in 2020 to 13 million in 2030. And as you may have guessed, they need charging stations. Well, Blink already has 190,000 plus registered members and 24,000 charging stations deployed, cementing it as one of the leaders in the EV charging station race. And yes, some car companies like Tesla and Rivian and the likes have taken it upon themselves to make their own charging stations. But there's of course a wide array of EVs coming from a wide array of different companies. And obviously at some point it's not going to make sense for companies to make their own charging stations. Unless they have maybe like a battery as a service model like NIO has, or they have some other subscription model that they want to loop in with their cars. But I think that for most EVs, it's not going to make sense to spend all that money to build the infrastructure out for every single company. That would be like making a gas station for each car brand. It just made sense for Tesla to do it because there weren't that many charging stations out there. But the more investment is made into charging stations, the less individual companies will need to actually make their own. They also have innovative ideas such as bumper technology, where you charge your car by parking it in front of a wireless charging bumper. Although I wonder what would happen if somebody ran over it, but nonetheless. Anyways, I think that Blink is one of the best values right now in terms of charging stations. The other one that we're likely going to be talking about soon as well is CLII. They are the leader in faster charging stations. And of course, our other charging station play is ChargePoint, which is the leader overall in charging stations. Now we have Blink, ChargePoint, and CLII. I mean, if we were being honest, all three of these are good plays if you hold them long enough, but Blink has earnings this week, which makes it even extra special. If you ask me, Charlie, can you rank these by good deal potential? I'd say, okay, Blink number 1, CLII number 2, and ChargePoint number 3. And that's just based on where they're trading right now. I think that all three of these are going to be huge winners in the future, but right now, Blink is looking very, very, very juicy, especially if we get a little bit of a cooling off this week. The approach that I take is, yes, we're at a good deal with Blink right now, but I think we're going to get a better deal this week. If we get the opportunity, I would say snap this up in the low 30s. That would be ideal. And then just be patient until we get another hype wave into EVs, which should be in the next couple of months. Now, BNGO is also trading a chunk below all-time highs, and they will be reporting their earnings on Tuesday. Now, I tend to have a bit of a pragmatic approach to most earnings. If earnings are good, great, we can ride the fluctuation up. If earnings are bad, great, we can buy the dip. The only time I try to predict earnings results are if we have enough data from the overall niche that it's in or its competitors to actually make a judgment on how well this company is going to be doing. Otherwise, I stick to a more pragmatic approach because, again, I'm not an insider in these companies, so I don't exactly know what they're going to be saying. BNGO is in the biogenomics space and is one of ARK's plays. Their big pull is the Sapphire system used for optical genome mapping. This can help us identify and early detect cancer as well as even fight COVID-19, where Sapphire has been shown to be effective in identifying COVID variants. My take is that if we could pick this up in the low 8s sometime this week, that sounds like a pretty damn good deal to me. And now for our requested ticker of the day, and the last ticker we're going to be talking about, Visa. So Visa got beat down like a rabid dog on antitrust investigations into their debit card practices. However, the overall niche I'm very bullish on. I actually think that credit and debit card providers are going to be some of the biggest benefactors of the COVID recovery. Obviously, right now, everybody's panicking. They're like, oh my God, all these people are going to start buying stuff. All these companies are going to be taking in so much money, and that means we're going to have insane inflation, and then the Fed's going to have to come in and ruin the stock market in order to fix it. But what you're missing there is if people are going and spending tons of money on consumer items, What are they using to buy those things? Well, credit cards and debit cards, which Visa is one of the leaders. This dip allows us to get a little bit better of a buying opportunity. Truth is that Visa has been around for a long time and they have had regulatory concerns in the past, but they've pushed through and nothing's changed. Obviously, these investigations are going to be a source of headlines for the next couple of weeks and maybe months, but I have a very hard time believing that this is going to impact Visa over the long run. I don't think that Visa is going to step down from being a leader in the space. So accordingly, when everybody's panicking on this, I see this as a good buy. If you can get this under $200, I see that as a good play. We could see some more selling off. Obviously, you could always see more selling off, but at below 200, I see that as a pretty damn good deal. Okay, folks, well, that caps off the video. If you have any questions, feel free to reach out to us below or join us in ZipTrader Circle. It's really a lovely circle and it's completely free, so make sure link below. If you'd like to learn how to trade, would like access to our private chat and daily morning briefings, we'll go ahead and check out ZipTrader U in the comment section below or in the description below. I have a link. If you'd like 2 free stocks and you're wondering what broker to trade these stocks on, well, Webull is a fantastic broker and I'll put a link to them below. And as always, have a great day and I'll see you in the next video.